Welcome to this special podcast, sponsored by Murphy Business Sales Edison, New Jersey office, where your business aspirations meet expert guidance. Whether you're looking to sell your business or explore new acquisition opportunities, we are here to support you every step of the way. Join us as our hosts deep dive into small business topics which are relevant for buyers, sellers, and other transaction advisors in the ecosystem.
Okay, let's dig into this. We're looking at forensic business valuation today.
Right.
Specifically, how experts put a price tag on a private business when, that number becomes the absolute core of a legal fight.
Yeah, the main point of contention, really.
Exactly. Whether it's divorce, shareholder fights, estates. Our sources show the real battle isn't always the complex math.
No, it's fascinating. The high-stakes conflict really kicks off with choosing the right standard of value. I mean, valuation is mandatory for things like tax, right? The IRS has rules like Revenue Ruling 5960.
Yeah.
Pretty clear-cut, mostly. But bring that valuation into a courtroom, the whole game changes.
Yeah.
Huge potential for conflict.
Right. So the default, the one we see for tax and, say, commercial damages, that's fair market value, or FMV.
That's the baseline. Your classic definition.
Yeah.
What a willing buyer and seller, both informed, would agree on. Neither forced to act.
But crucially, FMV reflects market reality. And that means you have to factor in some pretty big reductions sometimes.
Oh, yeah. The valuation killers, as some call them.
Yeah.
You've got the discount for lack of marketability, DLUM.
Because you can't just sell private stock easily, like on the NYSE.
Exactly. And then the discount for lack of control, DLOC, that's for minority shares because, well, you can't call the shots. FMV assumes a real sale, so these discounts, they're pretty much baked in.
Okay, but what if the goal isn't market price? What if the court is aiming for, fairness or equity?
Then it pivots. It moves to fair value. Now, this isn't an open market concept. It's a legal construct defined by state law, used specifically as a remedy in court.
A remedy, meaning?
Meaning it generally ignores the hypothetical buyer-seller thing. It tries to capture an owner's simple, proportionate slice of the whole pie, the whole business value. So generally, no DLUM, no DLOC.
Whoa, hang on. So if the open market FMV says a business share is worth, $10 million with discounts.
Right.
But fair value, without discounts, pegs it at $15 million. Isn't that kind of unfair to the person paying? Like the owner spouse in a divorce or the controlling shareholder? That's a huge difference.
It is huge. And yes, that's sometimes called the price of equity. You see this most starkly in divorce cases, matrimonial dissolution.
Okay.
Courts need to figure out equitable distribution. And many states, New Jersey's Brown v. Brown case is a famous example, flat out prohibit discounts in divorce.
Why, though?
The thinking is the non-owner spouse isn't actually selling their share on the open market. The owner spouse is keeping the business intact. Applying market discounts would unfairly penalize the spouse who's leaving,
Okay. That makes sense. You're dividing an existing asset held by the couple, not pricing a stock for sale to a third party. And related to that, experts also wrestle with goodwill, right?
Absolutely critical. And you have to legally split it. There's enterprise goodwill. Think the company's reputation, its brand, its systems. That is a marital asset, typically divisible.
Got it. And the other kind?
That's personal goodwill. That's tied to the individual, their personal contacts, unique skills, their future earning power. That's usually not considered a marital asset. Getting that split right, huge impact on the final number.
Makes sense.
And you see the same fair value logic in shareholder disputes, like minority oppression cases.
Okay.
If a majority owner tries to squeeze out a minority holder, courts use fair value without discounts. It prevents the controller from getting a windfall by basically buying back shares on the cheap.
So the standard FMV or fair value dictates the discount issue. Once that's settled, how does the expert actually, calculate the number itself? What methods do they use?
Well, they generally pick from three main approaches, sometimes called the three pillars.
Right.
First, the income approach. Most common there is the discounted cash flow, or DCF model. Courts tend to like this for operating businesses because it looks forward at future earnings.
Okay, future focused.
Second, the market approach, looking at sales of comparable companies. But this gets criticized. Finding truly comparable private companies. It's tough, often imprecise.
Yeah, I can see that.
And third, the asset-based approach. Mostly for businesses that aren't profitable or are basically just holding assets like real estate. Value is just the sum of the parts, more or less.
And whichever method they choose, especially something like DCF with all its assumptions, it has to get past the judge, right? The whole Doe-Bird or Fry standard thing.
Oh, absolutely. Judicial gatekeeping. Dobert, in federal courts in many states, demands reliability. Is the method sound, testable, and crucially, was it applied correctly to the facts of this case?
So a good method used badly is still bad.
Exactly. Experts get tossed out if their data is weak or if they misapply a perfectly good methodology. It shows the result isn't reliable.
And that's where all those acronyms after an expert's name come in handy, like ABV, ASA, CVA.
They definitely help bolster credibility. Those credentials signal the expert adheres to professional standards, things like SSVS or US PAN-DP. It's like armor against challenges, saying they don't know what they're doing or didn't follow the rules.
So the standards show they followed a reliable process.
Yes, and that the chosen method fits the legal standard required by the court. That's key.
Okay, so wrapping this up, the big takeaway for you listening. A business's true value isn't some fixed number. It really fundamentally depends on the legal question being asked. If the law needs equity fair value, the number can be way higher than what the open market FMV might suggest.
It really can, which leads to maybe a final thought for you to chew on.
Go for it.
What's often the biggest weakness in an expert's valuation? It might not be choosing DCF versus the market approach. It might be failing to get enough non-financial information. Think about it. If value hinges on future growth assumptions in a DCF, how much weight should a judge give that number if the expert never even talked to the management team? Never really dug into the non-financial risks and opportunities? Something to consider.
Thank you from all of us at Murphy Business Sales for taking the time to learn about this important topic. We look forward to working together to achieve your business aspirations. For more information or a complimentary consultation for sell-side services, visit us at murphybusiness.com/Edison and complete our Contact Us form.